Good morning. My name's Robert Coulter. I'm the General Manager for Partnerships here at the AFA, and welcome. The FASEA Code of Ethics on the 1st of January 2020 imposes ethical duties on financial advisors, and of course has been designed to encourage high standards of behaviour and professionalism in the financial services industry. Today's webinar focuses on the unique challenges presented for advisors when recommending risk insurance. We're delighted to be partnering with MetLife this morning with Dr. Jeffrey Scott, who's the Head of Advice Strategy, to present on and share insights about a number of real-life ethical insurance dilemmas. For people not familiar with Jeff has worked for over 25 years in the insurance industry as a certified financial planner, SMS specialist advisor, fellow of the Taxation Institute of Australia. He's a regular media commentator on topics of insurance, super, pensions and finance. He's conducted over 1,000 presentations in 13 countries, including the MDRT conferences in 2010 and 2017. Jeff created the first terminal illness benefit for life insurance products here in Australia, helped develop lump sum income protection benefits, and introduced full income replacement coverage. Now, before I hand over to Jeff, I'd just like to cover off some of the webinar housekeeping for you. Today's webinar, as you'd be aware, has one CPD hour available. What we're going to do is we'll send that out to you within the next week. So you'll receive that directly from the AFA. Jeff will answer questions at the end of the presentation. So if you use the Zoom QA feature, not the chat feature, but if you use the Zoom QA feature, we'll then curate those and we'll ensure as we get to the back end of this presentation that we present them to Jeff. Jeff, I've personally been looking forward to this webinar. We've had a lot of interest in this area, and I'm sure Jeff's insights as he explores these real life cases will be enlightening. Jeff, welcome. Thank you very much for putting this important information together to help our members. Over to you.
Thank you very much, Robert. And on behalf of MetLife, it's a pleasure to be involved with the AFA and a pleasure to be giving this presentation this morning. Now, without any further ado, I've been in the insurance industry for, again, as Rob said, the best part of 25 years, spoken about all kinds of topics. The past 6 to 12 months is the first time I've ever had to actually deal with presenting on ethics. And this is something that's brand spanking new to me. And I think it's going to be a challenge to most people, because what we're going to see over the coming years is that what ethics basically says is that it isn't necessarily the black letter interpretation of the law, but it's also with regards to what is your professionalism based, and also what are community standards stating as well. So before we get into the session, I remind everybody that there's obligations that every financial planner has. One is making sure your advice is appropriate to the circumstances. The second is a duty to your clients. So in other words, you've looked after their care and property, all the rest of it. The third obligation is your best interest duty, satisfying that safe harbor provision. And then there's an additional rule is conflict of interest rule. And it basically means that anything you do, you have to make sure that you're not put in a conflicted position that would cause you to provide advice that's inappropriate for your clients or could influence your advice side. So when we actually look at the professional standards, community expectations, and ethics, the one thing that we realize is, with regards to risk, has a very unique situation, because we have challenges with regards to underwriting, we have challenges with regard to personal information, we find out information about the client's health, their history, their activities, their pastimes, their behaviors, and then we have to tell the client, you have to tell us as much as you possibly can to meet your duty of disclosure and meet the utmost good faith rules. And if they don't, then what ends up happening is that could determine whether or not a claim is successful or it fails. So when you get all this together, we know for a fact that risk advisors already operate at the highest level and highest standards available. But the question now becomes that with this ethical situation that's been put over the top, what does that actually mean for risk advisors in their day-to-day situations? So that's what I'm looking at so far. Now, this is my all care, no responsibility slide. My legal and compliance team have taken full responsibility for everything I said. And even though I've taken every care to make sure everything I've put in here is factually correct, if there has been an error or omission, I apologize in advance. And the other thing is that anything that I say in this presentation is general advice only, or information. It is not personal advice. So please talk to your respected financial advisor. Now, what's the agenda going to be? There's going to be 5 major areas. The first one is ethical considerations and reflections. So why is this important? What's the current framework that we're looking at, and why are things going that way? The next thing is non-disclosure and remedies. So basically a really quick refresher as to what the Insurance Contracts Act says if a client does not adhere to non-disclosure rules. And then we'll look at 3 actual case studies and things that we've seen before. And again, I have to really thank Chris Kirby, because him and I brainstormed this and went through all these bits and pieces. And actually, we brought up situations where we have seen this over the past 25 to 30 years in the industry, where clients have actually walked down this path. So, and one of them is actually is in case law that we actually looked up, and we read it and we couldn't believe it. So this is a wonderful situation that you can actually have that chat about. Now, objectives and outcomes. What I'm looking at with this is that the FASEA Code of Ethics and other personal considerations. The Code of Ethics basically puts a frame around our ethical position and actions. So what we now have is this framework of the 5 values and the 12 standards basically states how we're supposed to be operating. Now, the one great thing is that when I look at the various financial advisors and risk specialists that I have dealt with over the past 20 to 25 years, and I look at how they operate their business, and more importantly, how they deal with their clients, you guys are already operating at an incredibly high standard. So this shouldn't be a big stretch for you. When we review and refresh those understanding of duty and disclosure and potential implications, what we need to realize is with the ethics situations, keep on reinforcing to the client what their duty of disclosure is, because the ramifications at the other end are significant. And what we're going to do with these 3 examples that I'm going to go through, just setting this up, is that we're going to weigh up the different courses of action and potential outcomes, look deeper at how duty disclosure works in practice, apply the learnings into your business process and what would that actually mean, and then consider how the FASEA Code of Ethics could relate to each of these cases. And what you'll find is that it's really easy to see the situation where your moral or ethical line has been crossed. And what we're trying to do with this is, when the moral or ethical line has been crossed, when does that occur? And is your moral or ethical line different than mine? And when I think about this as a kid growing up, I wanted to go outside and play sports with my friends. My mom basically said, "Jeff, you're not doing that until you finish your homework." Now, I couldn't see, since I had a very limited scope of experience and all the rest of it, I couldn't see the value of doing homework. I would much rather be outside playing ice hockey with my friends or playing football with my friends as a kid growing up. But when I didn't want to do my homework, I crossed my mom's moral or ethical line, because she saw the value in me doing my homework because it gave me more opportunities going forward. Since I didn't have that perspective, I couldn't make an informed decision. And it's the same thing with your clients. Since you know the impact of a client not meeting their duty of disclosure, you have an obligation to tell them and warn them what the implications are, just like my mom did to me with regards to my homework. So that's the situation, is that your experience, your knowledge, and your skills can hopefully help out your clients in these various circumstances. Now, with ethical considerations and reflections, what I'm actually going to be looking at this. When we look at all the things that you do, the personal relationships you have with your clients, and again, many of these are long-standing, and you've got a strong chance you know the client incredibly well. When you conduct your fact find with your client and you're meeting your know your client rule, you've got the personal statement, and you're helping the client fill out the personal statement. so they don't miss anything. And then you're helping them with electronic copy of the personal statement. Each of these situations is an opportunity for you to continue to reinforce why you're there, the importance of your relationship, and making sure the client meets their duty of disclosure. And that duty of disclosure situation with that personal information, and more importantly, making sure that only the people that see that information that the client provides to you is you and that life insurance company, again, helps build that relationship. So, FASEA Code of Ethics, again, there's 12 standards in the areas of ethical behavior, client care, quality, process, and professional commitment. And it says you must act at all times and in all cases in a manner that demonstrates consistent with these standards. So you don't get to have a day off with regards to the FASEA Code of Ethics. And these came in on the 1st of January, 2020. And we know for a fact that this is going to be monitored by ASIC. So again, when we look at this, there's also that overlay that we've discussed before. So is your advice appropriate? Are you meeting your fiduciary duty to your clients? Are you meeting the client's best interest duty? And are you making sure that there's no conflict of interest with regards to putting your client first? So with this situation, if you don't meet your code of ethics, what ASIC and FASEA have both said is that there'll be strong disciplinary and enforcement practices will be maintained in order to make sure this happens. So what we found is that with the FASEA Code of Ethics, it's about 3 things. One is, have you met a minimum standard with regards to Code of Ethics? And that's when you pass your national exam. Are you doing ongoing CPD, which attending this seminar today allows you to do that? Are you going to maintain the minimum? Are you going to attain the minimum standard with regards to your educational attainment, so AQF 7 or above? And then on a day-to-day basis, do you continue to do what you need to do? And again, how you do with your clients. This FASEA stuff is going to be overarching and ever-reaching with everything we do from now on, and it's why it becomes so vitally important. Now, the next situation that I'm looking at, personal ethical reflections. When I look at what we're going to go through with regards to these 3 case studies, I always come back to this, is that if in fact somebody such as Four Corners, or somebody such as Adele Ferguson, or somebody such as Rowena Orr looked at your behavior, and that behavior was in the front page of the Sydney Morning Herald or the Australian or the AFR tomorrow, would you be happy with your behavior being broadcast to everybody? And that's often the lens that you want to be looking at this. So there's a few lenses you need to be looking at this. The other situation is that, is there what's called a universal rule that applies here? So a rule that any reasonable person should apply to this situation regardless of the consequences. So some rules are unbreakable even when the stakes are high. So in other words, thou shalt not kill is probably a good one. And in that situation, you never want to have that being a case. Or you shouldn't steal from your clients. Again, everyone says, of course you shouldn't. That's dumb. But again, there's some universal rules that apply. And again, looking at what happens. The next thing is, will the proposed course of action bring about a good result? So when we think about ethics in terms of consequences, what you're thinking about here is, what's the greatest good for the greatest number is the maximum that we're looking at for this one. The next thing is, what would happen if everybody did this action? So what would happen if everybody said that they were a non-smoker on their application form rather than a smoker? What would happen to the rates? What would happen to claims experience? What would happen to premiums? And if everybody did it, then the people who were honest would actually be disadvantaged because their premiums would go up as well. So when we're looking at this is, if everybody did this, in other words, everybody had a special exception to the rule. If everybody had the exception, would that be socially acceptable? And the answer is probably not. The next thing we're looking at is that, what will this proposed action do to my character or the character of my organization? So if your other clients knew that you did this for one particular client and they were disadvantaged or they didn't get the same treatment, would that damage you? Would that damage your company? Would that damage the brand that you've built up over a number of years? And the last one is the proposed course of actions consistent with my values and principles? So in other words, am I walking the walk and talking the talk? So what I say I believe in, is that what I'm actually believing in? And so those are the things that we often look at from an overlay with regards to ethics and why this is so vitally important. So the guiding principles. One, when it comes to the situation with regards to client's duty of disclosure, you cannot make a person tell the truth. If a person's going to lie, you can't stop them. But what you can do is provide them with a decision that says, if you do this, do you know the potential consequences? So in other words, make them aware what their obligations under duty of disclosure are. Make them understand that if they don't disclose everything properly up front, what are the consequences? And the consequences are quite severe. One is that the policy could be canceled from inception. Two, the sums insured could be minimized significantly. Or three, if they make a fraudulent claim, so that's at the other end, but make a fraudulent claim situation, that all policies could be canceled on them. So what you need to do as an advisor is that if a client chooses not to tell the truth, or you think they might not be telling the truth, you have an obligation to say to them, what are the consequences if you're not doing this? And informing the client of the consequences means that they're making an informed decision. Now, if they still want to make that informed decision of not telling the truth and telling a porky pie, that's their decision. But what you don't want to have happen is you don't want to be the person that you knew the client was doing something wrong or could have been doing something wrong, and you didn't warn them that if they did this, what are the obligations? And what we say to most people is that make sure that your client reads their duty of disclosure obligations, make sure they sign it, and make sure you keep on reinforcing it on a regular basis. And again, you want to make sure that your actions aligns with the situation where it's basically you're dealing with the client efficiently, honestly, and fairly. So again, maintain those highest ethical standards. You can't stop your client from doing things that are wrong, but you can warn them what the consequences are. Same thing with, again, I go back to my mom and the homework situation. My mom basically said, if you don't do this, you won't get the opportunity, and you may have a crappy job. It's like, don't want to have a crappy job. You may not be able to travel the world and may be living in this little town of 8,000 people for the rest of your life. I'm going, ooh, don't like that either. So she basically put the threat of opportunities not being there. In your case with your clients, your threat is there may either be a delay in paying a claim, there might be various complications, or the claim might not be paid at all if they don't do this stuff up front. So again, the responsibility of the insurance company is to pay the claims properly. Don't delay paying a claim without proper cause, and we can't refuse to pay a claim without proper cause in that situation. The responsibility of the insured in that contractual arrangement of utmost good faith between the two is that they can't make false or exaggerated claims. They must cooperate with the insurer to try and get this stuff and disclose all relevant information. So that's their responsibility. That's their job, which is exactly what we're wanting all the way through. Now, non-disclosure remedies, a refresher. We've already discussed what they are. The non-disclosure remedies were really, non-disclosure remedies, again, in the first 3 years, if it's any type of policy, death, trauma, income protection, first 3 years, what ends up happening is that if there's been non-disclosure in there, the insurance company has the right to cancel the policy. After 3 years, if it's for death cover, the insurance company must prove fraud. For TPD, trauma, and income protection, after 3 years, the insurance company has the right to modify or vary the terms and conditions of the contract depending upon the level of non-disclosure. And for a claim situation, if a person puts in a fraudulent claim, and there's a difference between fraudulent and unsuccessful, but if a person puts in a fraudulent claim, then the insurance company has the right to cancel not only that policy that put the fraudulent claim in for, but every other policy with that insurer. So again, things to be mindful of when you're talking about this with the insurance company, with the individuals. Now, duty of disclosure, before you enter into a contract of insurance, you have a duty to tell us anything you know or could reasonably be expected to know which may affect our decision to insure you, and on what terms. Now, the Royal Commission has recommended that this get modified. It hasn't came through yet, but effectively what the duty of disclosure may turn into is duty of reasonable care not to make representation. So that's what may turn into, but as of now, as of today, the traditional duty of disclosure under Section 29 of the Insurance Contracts Act is still in force. Classifying non-disclosure, effectively there's two things. Fraudulent is where there's a deceitful mind or reckless intent. What they call misrepresentation or innocent non-disclosure, where there was a non-deceitful mind. So a person legitimately just forgot something, and it was something that most normal people wouldn't have thought to be an issue to begin with. So again, those things are all part of the process. And again, fraud, the insurance company can cancel the policy at any time for the misrepresentation that was what they call innocent misrepresentation. That one, there's opportunities to modify the terms and conditions of the policy at a later date for, again, TPD, trauma, and income protection. So remedies for non-disclosure, we already discussed this. If it's fraudulent, you can cancel at any time. Non-fraudulent, first 3-year rule. Insurer may vary the terms of the contracts for, again, TPD, trauma, income protection. And if you had a bundled policy, so a TPD and death, and the insurance company wouldn't have provided the cover on the TPD, but would have still provided the death cover, then they have the right to unbundle the policy and give the insurance on the death cover. So let's go through the case studies. And these ones I love because these are actual real case studies. And the thing is that sometimes what I find is that when we start talking about case studies, truth is always stranger than fiction. And these 3 case studies are things that we've actually dealt with. Myself and Chris Kirby went through this, and we've actually sat down and talked to various people who deal with claims on a regular basis. So Pub Talk's the first one. This is the one I find quite interesting because the first one goes like this. A long-standing financially viable client has income protection policy. They're on claim. You helped do the administration and got the claim accepted. After you do this, you're in the pub, they're in the pub, so it's obviously post-COVID or pre-COVID. You hear them in the pub bragging that they're pulling a fast one over on the bloody insurance company. So if that's the case, then what do you do? And so the question with this one is, you hear the guy, he's had a couple beverages, Friday night, he's out with his mates, and he's having a bit of a yarn. And after he does so, he basically says, oh yeah, I pulled a fast one on the insurance company. So what do you do? So the various things that start going through your head are, well, is this fraud or just pub talk? So if this guy's basically had a couple beverages and like most fishing stories, you get to the pub and you basically tell people, oh yeah, the fish I caught last week, oh my, it was 1 meter long, had to weigh at least 20 kilos. It was a superstar. Now, it was probably a minnow, not much bigger than your finger, but you tell them and you do your bits and pieces. Now, is that the case? Do you have any obligations? So as their advisor, and you hear them say this to their mates at the pub, do you have an obligation? And if so, to who? Do you have an obligation to the client? Do you have an obligation to your dealership? Do you have an obligation to the insurance company? And then the question is, should you challenge the client? And if so, where and when? I probably would recommend that if you hear them doing that in the pub and they've had a couple beverages, it probably isn't the best to challenge them in the pub. But when you do your next review with that client, how do you address it? How do you raise this? And the other thing is that if the client is actually telling the truth and it is fraud and they are pulling it over on the insurance company, how does this impact on your other insurance clients? So if this one's a fraudulent claim, then this means that your other insurance clients could actually have a situation where they're paying a higher premium. And then the next question is, should you care about the life insurance company? Which, again, you're saying they're a big guy. One claim's not going to hurt them. Is that your attitude? And again, under the situation with regards to the ethical framework with regards to FASEA, the answer is you can't afford to do that anymore. So the next one is that, how do you whistleblow? Can you whistleblow? And if so, to who? Well, the first question, when it comes to whistleblowing, the first thing you always do is talk to your licensee. Talk to your legal and compliance team within your licensee as your first port of call, because they will likely have a process or procedure in place to help do this. So that's the first place you go. Can a life insurance company use investigators to go and check? Will your business lose money by taking action? So this is one of your great clients, and you confront him. Is there a chance he could walk up and take his business elsewhere? And then the other question is that what would other clients expect of you? So you have this situation and you've got all these dilemmas. Now, what is the thing that people think about? Well, one, talk to the customer, the impact of fraud and consequences. Now, the one thing that I mentioned to somebody is that there are some insurance companies that do what's called pay and close. So they take a look and say, Jeff, you've broken your leg. We think you're going to be off work for 6 months. And since you're going to be off work for 6 months, what we're going to do is we're going to pay you 6 months in advance. And if you're still on claim after the 6 months, come back and talk to us. Now, if I go back to work after 3 months, and I've still collected the additional 3 months on top of it, then I think I pulled a fast one on the insurance company. They paid me for 6. I was only off work for 3. Aren't I great? I've just made a profit. Now, is that any non-disclosure? Absolutely not. Can I go down to my mates and tell them I pulled a fast one on the insurance company? Well, technically, yes, because I heal quick. But again, it's making sure that you, as an advisor, you actually understand the context by which that decision was made. The other thing is that when you're doing your review with a client, don't be afraid to tell them, remind them the impact of fraud on the consequences of the claim. If you legitimately think this client is making a fraudulent representation to the insurance company, then you possibly shouldn't make any more future representations to the life insurance company, and maybe even withdrawing the previous claim representations, because you don't want to be tarred with the same brush as the client. Again, understand what your licensee or whistleblower internal policy is, and understand what professional standards says. Professional commitment says individually and in cooperation with your peers, you must uphold and promote the ethical standards of the profession and hold each other accountable for the protection of the public interest. The public interest is you don't want to have people making fraudulent claims. But if it wasn't a legitimate fraudulent claim, then be very careful as to how you approach them. So in this situation, merely overhearing something at the pub comes from perspective. You take a look and say, that's not a fraudulent claim. This guy broke his leg. He healed quick. He was back to work early. The insurance company did a pay and close, paid him 6 months in advance. He was back to work in 3. That's not fraud. On the other hand, the person basically said, actually, I've been back at work for the past 8 months. I'm still getting paid by the insurance company. I've been working full time. Now we have fraud. So again, understand the context by which the person is making the claims, and make sure that you go to your dealership first and ask that first. Again, this is probably one of the toughest ones that we came across. Next one, Total the Genes. This one's caused a whole lot of problems. And it's amazing the debate that I've had when I've had this in open forums with regards to this all in the genes. So, actual case study. And here's what it looks like. A very close friend of the advisors diagnosed and successfully beats a diagnosis of breast cancer. So has breast cancer, goes through the radiotherapy, the chemotherapy, all the rest of it, and beats it. Subsequently becomes active in fundraising and participates in a genetic test for breast cancer as part of a research program. You're not aware of the results. Since this client of yours knows that she's had a history of breast cancer, she goes to you and says, can you please contact my daughter and make sure that you give her appropriate insurance advice? Because I want to make sure that she gets all the insurance that she needs in case anything happens to her. So again, forewarned is forearmed. So she goes in and does that. Puts it all together. And when completing the tele interview, the daughter does not make any disclosure in relation to her mother's genetic test or family history. You get an electronic copy of the personal statement and notice that the possible issue of non-disclosure. So in this case, what do you do? And this has created a significant debate when I've talked to financial advisors about this, because you have personal information about the mother. You know the mother has actually been on claim for breast cancer. You know that the mother has a genetic test with regards to breast cancer as well. And you know for a fact the reason that the mother wanted you to talk to the daughter is she understands the family history with regards to breast cancer. That if the mother has it, the chance of the daughter having it, potentially contracting it at a later date, is significantly increased. So that's the situation. Now the question becomes that even though you're privy to the health information of your client, the mother at age 50, will the daughter be privy to the same information? And this has created just an incredible debate when I've discussed this with people. Because quite simply, when I think about my family, what ends up happening is that my father passed away 2 years ago. He never said boo about how he was feeling until he basically went to my sister and said, can you take me to the doctor? I'm not feeling that great today. Okay, takes him to the doctor. My dad was 80 years old. My sister takes him to the doctor. They do the test, and they realize my dad had stage 4 lung cancer that metastasized to his bones. Now, he wouldn't have told anybody and he didn't want to tell us, the rest of us kids, but my sister basically told the siblings. My mom has the same type of approach. I don't want to bother the kids. I don't want to tell them. And so my mom actually had a situation. She's in hospital for a week, came back, was home, and didn't tell us that she happened to be in the hospital for a week. Again, I live 10,000 miles away. I have another sister who lives 4,000 miles away, and they had those problems. Now, the question becomes that if the daughter doesn't live at home with mom and hasn't seen her being sick, is there a chance the daughter may not know about the cancer? And the answer is that is a legitimate chance. So the question becomes, is this non-disclosure? So if I don't know someone else's family history, am I obligated to disclose their family history? And the answer is, if you don't know it, you can't disclose it. And people say, well, the insurance companies put family medical history. It's like, yes, if you know it. But if you don't know your family's medical history, or you're not sure, or anything like that, then you can only disclose what you know or should have known. Now, you know or should have known your own medical history, but you do not necessarily need to know somebody else's medical history. And in this case, the mom may have gone in for her treatment on the Friday. Saturday, Sunday, she basically recovers, and by Monday morning, she's back at work again. And I've met 3 women who did exactly that. So if the mom did the same thing and the daughter was living away from home, the daughter may have never seen mom sick, never knew, and may have just thought, well, the reason that she's involved in this breast cancer stuff is she has friends that had the same thing. So again, the daughter may not have known. Are you required to disclose somebody else's genetic test? And the answer is absolutely not. So life insurance companies, if you have a genetic test, if you've had one done, then yes, you have to disclose it. An insurance company cannot ask you to get a genetic test done if you haven't already had one. They also can't ask you for the results of somebody else's test. But if the daughter knew the family medical history of her mom, then yes, she has to disclose it. But if she doesn't, and again, I know some families, when it comes to health, they don't tell their family members about their health. If that's the case, not a situation. So if you've done a genetic test, and even if it was for research purposes, and you know the results, and it's on you, then yes, you have to disclose that to the insurance company if you're doing this. Now, is paper-based and tele-based underwriting providing a safer option for you or the client? In this case, tele-based, where the insurance company rings up the daughter, is probably safer for you, because you don't want to have that conflict of interest where you know the mom's health details and you can't tell the daughter. So in this case, the tele-underwriting situation where you're not helping them out, they're actually being contacted by the insurance company, is probably a safer option. But again, do you still have a duty of disclosure? The answer is yes. So quite simply, if she knows the mom's family medical history, in other words, knows about the breast cancer, then yes, the daughter has to disclose it. But if she doesn't, and there may be legitimate reasons why she doesn't, there is no obligation on the daughter to disclose this. And this is something that basically caused a whole lot of problems. I've had a whole lot of discussion. Now, what if I don't know my family medical history? I've been adopted. And people say, you got to tell your family medical history about your mom, your dad, your grandma, grandpa. Well, say, I was adopted, I don't know. Or you ask your parents about their family, about their medical history, and they say, none of your business, I'm not telling you. So if that's the situation, then you say don't know on the application form. Now, if the insurance company reads don't know, they can say, yep, fine, you don't know, so we may want to send you for additional tests. So blood tests, EKG, ECG, urinalysis, all that stuff. But if a person legitimately doesn't know the family medical history, then quite simply, they don't have to disclose it. But do yourself a favor. If your clients don't know, get them to tell them, I don't know. So tell the insurance company, I don't know. Make it really simple. Don't know, my parents won't share it. Sorry. Easy. And that way they're not lying. It's real simple. Now, in summary, reaffirm the duty of disclosure of the consequences to the daughter. If she legitimately doesn't know, again, privacy issues would make challenging the client directly or family history inappropriate. So in other words, you might know the information about the mom. You cannot tell the daughter unless you are sitting in the office where the daughter actually told the mom right in front of you, dear, I have breast cancer. And she was sitting in the office and you actually heard it, then quite simply, you cannot challenge this. The insurer cannot ask the applicant to undergo a genetic test, but any existing genetic test can be used in the underwriting process. And it can only be used for the tested applicant, so the individual themselves. Disclosure of third party or family history is problematic, and essentially it's an honesty question. So again, if the insurance company isn't certain or wants more information, they will send your client for a medical, a PMAR, or additional tests. And that's what some of them often do. Now, does paper tele-based underwriting strengthen or weaken the duty of disclosure, and how do you avoid being responsible? The legal case say the court recognized that insurers routinely take applications over the phone. The court confirmed that during these calls, it's not reasonably practical for an insurer to give information about the duty of disclosure in writing, but they have to give it verbally over the phone. The insurers must also give the information orally during the call and must also give the information in writing within 14 days. If they've done that, then the insurance company has provided the duty of disclosure information to the client, and the client can go from there. So again, that's what we actually find. Now, number three is where we have truth is actually stranger than fiction. This is an actual case study. And when myself and Chris Kirby read this one, we looked at it and we said, this can't be right. But this is an actual case study. So here's what happened. So this went through the courts, and here's what occurred. So your client is applying for insurance and declares his weight to be 80 kilos. From your experience, you know that they're considerably more than 80 kilos, but they said now they're 80 kilos. So what do? So you know the person he's not in the normal BMI, he's actually not even in overweight, he's in morbidly obese situation. So this isn't just 1 or 2 kilos. This is a situation where he's actually over the top. What do? Well, you could do nothing. It's the client's responsibility. I'm not going to worry about it. I know that I know he's wearing XXL shirts and XXL tracky dacks when he walks into my office, but I'm not going to actually question him about it. Do nothing, it could be wrong. Maybe I misunderstood his weight. Or maybe you do nothing, it's too embarrassing. You don't want to offend him. You don't want to talk to a person about their weight. Oh my goodness. Or do nothing, have the life insurance company prove what someone weighed years later. They can't prove it, who cares? It's too much of a hassle. Or you could do something. Make light of the situation, saying, have you understated your height? So again, or what you might do is in your office, you may actually have a set of scales in your office and actually say to the client, come on over, let's stand on this. Let's have a chat. And in this case, does Professional Standard 6 apply? So Professional Standard 6 basically says you must take into account the broad effects arising from the client acting on your advice and actively consider the broader long-term interests and likely circumstances of the client. So this is FASEA Professional Ethical Standard number 6. If you know for a fact that due to the person understating their weight by a significant amount, not just 1 or 2 kilos but by a significant amount, could actually preclude them from having a claim being paid, and you have an obligation to the client to warn them about their duty of disclosure. And that's what this is stating. So what actually happened? Well, here's the real case, and this is surprising. Legal case study. Client applies for cover in a tele interview in 2009. He declares his weight to be 110 kilos. In 2013, he dies, and he's weighing at the time of death, 3 years later, 180 kilos. So 70 kilos more than what he stated on his application form. His weight was recorded in 2008, so less than 12 months before he applied, at least 180 and likely more than 200 kilos. So the question is, how did he go from 200 down to 110? So lost 90 kilos. It goes to court. The claims declined due to non-disclosure. The estate argued that between 2008 and 2009, he lost weight and subsequently regained it. So basically went on a great big health kick, went on the diet, lost the weight, and that's why he was down to 110 kilos. The insurer thought there was something suspicious. So they went and obtained invoices from king-size beds, big and tall, and also went on to Facebook just prior to the date of application and looked at the various photos on Facebook and could demonstrate that his weight was at least 90 kilos heavier than what he disclosed on his application form. Since he declared his weight with what was called reckless indifference, the courts held that it was a fraudulent application and the policy was avoided. So in this situation, where the client states their weight with what's called reckless indifference, then in that case, the insurance company has said this is equivalent to fraud. Now, if it's 1 or 2 kilos, well, put it this way, 1 or 2 kilos, that's a good Sunday roast for me. So that's not an issue. And if a person has actually had lost weight, that's fine as well, but make sure it's been well documented. So if they've been very big before and they go in and they're going to apply for cover, have them go to their doctor and have their doctor actually record it someplace, or you record it someplace. Again, having scales in your office might actually work. But again, make sure that it's legitimate and you've got what they call contemporaneous evidence to prove what that weight is, especially if it could potentially be contentious at claim time. So one of the things that we found that has the most, that people often tell the most porky pies on their application forms, the things that are often understated or non-disclosed, and it represents some of the most common areas of non-disclosure: a person's height. Men often state that they're taller than they are. Their weight. Women often state that they're weighing less than they are. Alcohol consumption, how many standard drinks per day and how many standard drinks per week. Tobacco, people still don't say that they smoke when they are actually smoking regularly. And the use of social recreational drugs. Those seem to be the top 5 things that people don't disclose. And it's amazing that if you don't disclose them, the information that actually that they can detect these days. So again, if the clients are doing this stuff, get them to disclose it. With these questions in particular, clients shouldn't treat them just as guesses, or that they think the insurer will never find out. With the monitoring techniques that they have now and the way that they can do the analysis, it becomes far easier for insurance companies to find this information out. So again, get your clients to actually do this stuff. Get them to tell the right weight, tell the right height, the proper alcohol consumption, proper tobacco consumption if they actually use recreational drugs, because you don't want this to come back to bite you, especially at claim time. So get the clients to actually recall as best they can all those information. So in summary, the FASEA Code introduces new ethical considerations. Now, the one great thing is that knowing the various financial advisors I have dealt with over the past 25 years and how you guys deal with your clients and how you take them through the process of both the application, the underwriting, the duty of disclosure, and at claim time, the majority of advisors that I've seen across the industry do this incredibly well. So the FASEA Code should not be a higher imposition or a higher standard than what you're already operating at, which is wonderful. Again, continue to remind your clients that non-disclosure may have a huge impact at claim time, and then also at claim time, make sure they're not putting in a fraudulent claim. Now, what's the difference between an unsuccessful claim and a fraudulent claim? Your client basically has a mole removed from their body. They see this mole and they say, I wonder if it's cancerous. I don't know. They have the biopsy done. Biopsy's done. It then gets sent to the insurance company and they say, can I apply for a cancer payout on my trauma policy? Because I'm not, and I'll send the results across. The insurance company looks at it and says, actually, doesn't meet the Clark thickness, doesn't meet the Breslow thickness. Based on our definition, you do not meet the standard of a cancer payout on your trauma policy. That's an unsuccessful claim. Perfectly okay, no issues whatsoever. Client didn't meet the criteria. That's perfectly okay. A fraudulent claim would go something like this, and this is one I had when I was working at another insurance company. Client and their family went overseas on an overseas trip. Client drowned on the overseas trip and they couldn't find the body. The country that they were in actually gave the family a death certificate. Family comes back to Australia, lodges the death claim. The insurance company I was working for at the time was also associated with a bank, and they recorded some suspicious transactions from the dead person's ATM account. Remarkably, the person's account was being accessed at an ATM machine, and ATM machines always have this security thing called a camera that looks at the people taking the money out. And miraculously, this person who is deemed to have been dead was actually taking money out of his own account on the Gold Coast. That was a fraudulent claim. The person was alive. His family knew that he was alive, and the death certificate was basically a fraud, hoax, or forgery. In that case, that particular policy was then canceled, and all other policies that that individual had with that insurer were also canceled. That's fraud. Different to an unsuccessful claim. Now, utmost good faith is a two-way street. And the last point I want to make is that when we come to an utmost good faith is the client agrees that when they apply for the policy, what they're going to do is they're going to provide us with all relevant information. On the flip side, what they also say is that they will continue to pay their premium, and at claim time, they provide us with all relevant information for us to assess that claim. What the insurance company then says is that provided you continue to pay your premium at claim time, we will basically assess the information as quickly as possible, and we will not delay the claim by any undue means, and we'll try and get that money to you as quickly as possible after we've done our due diligence. Makes perfect sense. But utmost good faith is a two-way street, and both parties need to be there. Rob, that's pretty much it for me. I saw a bunch of questions coming through, and I look forward to actually finding out what the questions that we have.
Great, thanks, Jeff, and appreciate it. You're absolutely right. There's a host of questions. The first one here is that you mentioned that that if the client is not telling the truth in the health declaration, you have to tell them that it might affect their or impact their claim. If you know something, should you then tell the underwriter?
Realistically, this has to be the client's duty of disclosure. And again, the client has to be the one who's telling the truth on there, because realistically, it's their responses on that application form. And what I'd be saying to the client is, it's your obligation to do this stuff. And again, giving the client enough information so that they can make an informed decision is what you have to do. Should you be telling the underwriter? The answer is absolutely not. But again, the question is, if you think this client is blatantly lying on their application form, then the question is, do you represent them anymore? And that's where your ethical dilemma comes in. Okay,
and I think you answered this particular question through the webinar, but when it says that there's a family health history, does it imply that the client should seek for this information? And I think you were answering in a couple of different ways.
Yeah, the answer quite simply is no. The easiest answer for this is that if you know it and you're sure that you know it, then great, say it. But there's no obligation for me to ring up my mother back in Canada. So if I was to apply for insurance today, for me to ring up my mother back in Canada and say, hi, Mom, I want to know your health history. She would tell me where to go. And so easiest thing to do on that is that if you don't know this information, easiest thing to do is tell your client, say, I don't know, or unavailable. And that provides a clear indication to the insurance company that information on family health history, the client is not aware of what it is. And what that may mean is the insurance company may then send the client for additional tests. But again, unless you actually know that information, then again, there's no obligation for you to provide it, but the insurance company then has the right to then ask for additional information.
And it probably goes to the next question we've got, and I know you've answered it, but just for clarity, the question is, if someone says they don't know, as you were just indicating before, Jeff, can the insurance company force them to do a genetic test prior to accepting the risk?
Absolutely not. All the insurance companies have signed up to the FASEA Code on this, and when it comes to genetic testing, if the person has already had a genetic test done, then yes, that information can be used by the insurance company. But if the person has not had a genetic test done, the insurance companies cannot request this. Now, the one thing I will let people know is that often the ones that people forget about from a genetic test is anyone who's gone for IVF. Normally, if I've gone for IVF, one of the first things the doctors do if a couple has gone for IVF is they send both the male and female partners off to get a genetic test done. And so that information, if they've done that, can be used by the insurance company as part of the underwriting process. But again, if they haven't gone for a genetic test prior to, the insurance company is prohibited from asking them to go for one.
Okay. So there's a sort of a scenario that's been posited here. A client is stalling, for example, a client is stalling on a medical exam, which was requested for underwriting, applications in progress. Reason for the stall is that they're trying to get their weight down. Client has had no recent doctor appointments, so no record of his weight. Assume the client has a high BMI. What would your comments be on that? So essentially they're stalling, trying to drop some weight to get into the right BMI classification.
What I've seen with a lot of the insurance companies now is they have an additional question in there saying, have you had a percentage loss so have you lost more than 10 kilos in the past 12 months, or have you had a percentage loss of more than 10% in the past 12 months? So that they often ask that question. And what they often will be looking at is not only have you lost the weight, but how long have you kept it off for?
Yeah.
And so and I've had this conversation with one of our senior underwriters at MetLife, and his name's Simon Dent, and both Simon Dent and Adrian Young have said what they do is they say, so let's say I was at 200 kilos this time last year. As of today, I'm now 100 kilos. What are you going to take as your weight? And what they will normally do is they'll literally do a linear extrapolation and say, okay, your weight 12 months ago was 200 kilos. Your weight as of today is 100 kilos. You haven't maintained that weight of 100 kilos for more than 12 months. So what we'll do is we'll basically split the difference and say that you're at 150 as far as underwriting purposes go. So again, they want to see not only that have you lost the weight, but have you kept it off? And normally they have what's called the 12-month rule. If you're not sure, make a phone call to your underwriters, because they're more than willing to discuss this. But that's what I'm seeing as a common theme with the clients now, because one thing I've also realized is that the most recent figures with regards to gastric bypass surgery is that Australia last year had 22,000 gastric bypass surgeries where people are wanting to have a rapid reduction in weight. So again, this is something that's going to be quite common, and there's now a underwriting theme or underwriting process to actually look at this from an insurance company's point of view.
Question out of case study 3. So how did the insurer know that in 2008 the client's weight was recorded between 180 and 200 kilos?
This person had other issues with their doctor, and they were able to actually go back and look at the medical records. And again, since that person died so quickly after taking out the policy, it raised alarm bells with the insurance company. So usually if you have a death claim, so if you have any claim in the first 3 years, it raises alarm bells to the insurance company, and they go, does this look legitimate? And again, if it's due to accident, so if I was in a car accident, they go, yeah, that's part and parcel, couldn't do anything about it. But if it was due to a disease or illness, then the insurance companies will normally go back and do an investigation to say, in 3 years, why would this person pass away already?
Yeah.
And again, especially if you're under 50 and all the rest of it. So they went back and looked at the medical records. They were able to find that the medical records, he was over 200 kilos with the medical records and had seen his doctor for something similar. When he applied for the insurance, again, he said he was 110, but there was no medical records to support that. And then when he passed away, when they did the autopsy on the guy, again, he was well over 200 kilograms. So when you started looking at the various bits and pieces, the insurance company goes, well, wait a minute.
There was enough evidence, clearly.
There was enough evidence there to say, let's connect the dots and say, is there a high likelihood that he would have been 110 kilos? And when they said no, then they said, okay, what other supplementary evidence could we get? And that's when they went and said, okay, let's look at what Facebook said, and let's look at his receipts of things that he bought. And they were able to connect the dots and provide enough evidence to the courts to say this person stated his weight with what's called reckless indifference, i.e. fraud.
Yeah. A question, and I'll just read it directly out. So if my client has come from overseas, am I breaching an ethical boundary by telling or warning them that if they tell me about overseas drug use, then am I duty bound to ensure that this disclosure is consistent? So by implication, or even if I stated, if they don't tell me, I can't know. I don't know whether using drug use overseas or locally makes a difference. Jeff?
Put it this way, there's the old saying that what goes on tour stays on tour, and people may have been to various places, and that's the case. That's okay when it comes to whether or not you're going to tell your friends or family, but when it comes to insurance, quite simply, if you've used and all the rest of it, and even if, again, I'll use the old Bill Clinton situation. Yes, I smoked marijuana, but I didn't inhale. Yeah. If you've done it, again, disclose it, because the one thing you don't want to have happen is that if there's ever an autopsy done and the person has traces that they continue to use and there's any traces of that, what's the situation? So again, tell your clients honesty is the best policy. Disclose as much as you possibly can up front. And then when it gets to claim time, there's no ambiguity. And I had this conversation with a good friend of mine just last week where the friend basically said, I said, have you ever had any medical problems? And they said, yeah. I said, can I see what you actually put on your application form? And she said, I put something that happened 20 years before the application. And I go, yeah. And then she goes, I've had no implications since, no issues. And I said, good. I said, but what ends up happening is that if anything ever pops up, you can basically say, yeah, I told them about this thing that happened 15 years ago, 20 years ago. And at claim time, they go, yep, they told us about it. We knew about it. We didn't ask any additional questions. We're good. And it makes it far easier to believe a client if they've told you as much as they possibly can up front, rather than we think that the insurance companies have a philosophy that if they've lied to us about one thing, then what else have they lied to us about? And they start digging deeper.
So along the same lines, Jeff, re family history, what if a client thinks there's a medical diagnosis in their family, but doesn't have evidence and isn't able to obtain further information? Is it best practice for the client to disclose it and to provide background and to provide what little background they have on the situation? Again,
unless you know, then you're speculating. So in my case, I know for a fact that my father died of cancer at age just before his 80th birthday. So that I can state categorically, not an issue. I know my mom has gone to the doctor for various things, but I don't know what she's gone to the doctor for. I don't know whether it's been for a cold or the flu or something more serious. And so even though I might speculate that she's gone there for other things, I have no way of knowing. And unless she tells me outright that, Jeff, I'm suffering from this condition, that condition, the other condition, quite simply say, the easiest thing to say, if you're not sure, I don't know. For my dad, I know that he died of cancer. for my mom, I don't know what her ailments are. So there's just no way I can state that.
Thanks, Jeff. We've got another excellent scenario here where an advisor is listening right now recently had a client whose application was declined due to illicit drug use, so which the person had disclosed in a tele-interview. I'm aware, so the advisor is aware that he has another life policy which he bought online via iSelect, so which was not underwritten. What should that advisor do, if anything?
In many cases, those particular policies, read the fine print, because what they'll often do is they'll accept you without medicals, without underwriting, but they often will have either a pre-existing condition clause in there, or they may actually have another clause in there that says if the claim has been due to illicit drug use, improper use of alcohol, or self-harm, then those ones might be exclusions in the policy. So again, what I would do if a person bought that policy online, get them to read the fine print, or get them to bring it in and let you read the fine print. Because sometimes what they call the pre-existing condition clauses or exclusions that are on those policies could be quite prohibitive.
Good call. Another question, how would an insurance company know if an applicant has previously had a genetic test?
Put it this way, in many cases they don't know unless they've disclosed it. But again, often that question has been asked on the application form, and if it's been asked, then you have a responsibility to say, yes, I've had one, and the details of it.
And again, I think you've answered this, but again, the question is, what happens in the case where the insured wasn't aware of family history, so say breast cancer through sister or mother, at application, and the insured was accepted at standard rates? Will there be an issue with a future breast cancer claim? So they weren't aware. No.
Yeah, if you are not aware and there was no way for you to be aware, then that's fine. On the other hand, if prior to this happening, you are a friend of your parents or your auntie on Facebook, and they basically have a great big banner on their Facebook sign saying, I was diagnosed with breast cancer today, which some of them actually have, and you regularly, and they can show that you regularly put comments on there saying, oh, that's too bad, blah, 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 then again, you will know. So again, sometimes your actions of various things will actually put you in that position, but realistically, if they had it and you have no way of knowing, so again, I keep on thinking about my parents. My parents don't like talking about their health. And even though I might think there's something wrong with them, if I don't know what that is, then all I can say on my application form is, I don't know of what the family history is, and make it really clear. But again, if it's really open and I've acknowledged it, then again, disclose what you know. But again, it's the term that we always have in the disclosure situation, and what it says in the Insurance Contracts Act is anything that I know or should have reasonably known, which means anything about myself, I absolutely have to know that stuff. Anything about another person, if it's open family knowledge and everybody in your family knows, why? Because you've actually gone to the hospital and visited them when they were actually having the cancer treatment. That's kind of obvious. But if the situation is that you don't know and they don't want to disclose it and there's no way, then be really honest with the insurance company. Just say, I don't know, and tell them. It keeps it really easy for them.
So thanks, Jeff. Another scenario, and just an advisor wants to confirm. So can you please confirm the scenario that if I know as the advisor that a client has made a fraudulent statement of disclosure, I am actually not ethically obliged to inform the insurer. So should they or shouldn't they, if they know that the client is fraudulently?
Put it this way: you're under no obligation, but the question is, should you be representing this client in the first place? And the question then becomes is that you should probably talk to your licensee or dealership to make sure you know what the whistleblowing procedures are. So again, you've got no obligation to tell the insurance company, but the question becomes is that if there's a situation where there's a particular case that I was involved in, where I sat down with the advisor, where the client blatantly non-disclosed.
Yeah.
The advisor asked all the right questions, but the advisor was implicated because he didn't tell the client on they reckon there was one more circumstance where he should have told the client that you have to be aware of non-disclosure, and they didn't, and the advisor became jointly and severally liable for the claim that got denied. So again, it's one of those things that if you know the client's doing it, make sure you've got it in writing, that you've told the client on numerous occasions about their duty of disclosure and what the implications are if they don't disclose. And again, we said before, you can't.
Yeah, sorry,
Yeah,
Jeff.
yeah, go ahead. And again, like we said, you can't force a person to tell the truth, but you can tell them what the consequences are.
We'll take another couple of questions, Jeff. We have got plenty here, but I am conscious of time. So, a really good question here is, with all these possible non-disclosure issues, is there an obligation for a client to tell the insurer if anything changes in the future? So, i.e. each annual renewal providing an obligation for redisclosure. What's your views?
Not yet. The problem is that may occur under the potential due diligence obligations and product intervention powers. So there's proposed legislation that actually might be something that comes in. As of today, so as of right now, with the legislation we had in all previous policies, the obligation for the client is when they apply for the policy and all the way up to and including when the policy goes in force. So it's been going through underwriting, but until the policy is physically issued to the client with the policy schedule attached, there's a duty of obligation on the client. So again, make sure that all the way up through and until that situation, if anything changes, if they see a doctor, if they have various things that possibly go wrong with them, if they're not feeling well, that they basically tell the insurance company. Because there's been various case law over the years that a person applied for the policy, it was going through the underwriting process, and prior to the policy being issued, something changed with their health. They knew something changed with their health, but they didn't tell the insurance company, and the insurance company had the right to avoid the policy. So again, just be mindful of that.
So, final question here, Jeff. How far back can an insurance company go to obtain medical records in the event of a claim?
Quite simply, if they think it was a fraudulent situation, they can go right back to prior to the policy being issued. So it's, again, if they think it's fraud, there's no limitation on this. Yeah. And so again, it's why I keep on coming back and saying to people about this: make sure your client tells the insurance company everything they know, because under the law, the way it's currently stated, the way it's currently, there's no statute of limitations on this. And if the client was fraudulent in their application, the insurance company has the right to go back to any period of time to prove this stuff. Now, again, there's potential legislation that's been proposed by Hain that says that they're trying to modify that. But as we stand today, there's no statute of limitations. The insurance company can go back decades if they think there was fraud.
Yeah. Jeff, we'll call it to a close there. We ran through till midday and we're 10 minutes past. I'm conscious of the people that are online. Jeff, thank you for putting together such an excellent presentation, exploring ethical dilemmas, but I think the considerations, the reflections, frankly, I think the case studies were excellent. Pub talk, it's all in the genes, and a weighty dilemma. You can tell by the questions and the engagement that this really hit a chord. Thank you to MetLife for putting this together. Thank you to all the people who are listening online. This presentation will be available. I know a number of you have asked for it. That will be available on the AFA website the next day or two. Remember, we will also send out your CPD certificate. Thank you so much for your time this afternoon. Once again, Jeff, congratulations and thank you. And we look forward to joining you all again shortly. Thanks and good afternoon.
Thanks, Rob.